Today, I'll be breaking down Apple's fundamentals. I always start with 5 dimensions, a proprietary system where I dissect the fundamentals of a business. Let's kick off with the first dimension, growth. Apple's growth story is nothing short of remarkable. Over the last decade, Apple achieved a great 109.7% surge in revenue, with a decent annual average growth rate of 7.7%. Apple's growth is intricately tied to the upcycles of the iPhone. If you look closely, the years marked by the most substantial revenue growth align with the biggest iPhone upgrades. Given the absence of a significant iPhone upgrade this year, it raises questions about the potential for substantial revenue growth. Or will the Apple Vision Pro be the catalyst for driving significant revenue growth? When it turns to net income growth, Apple maintained an impressive 9.4% annual growth rate, resulting in a total increase of 145.5%. Earnings per share demonstrated a remarkable overall growth of 280.7%, translating to an average annual growth rate of 14.3%. Concluding this initial dimension, free cash flows exhibited a noteworthy total growth of 87.7%, averaging 6.5% per year. Now, let's shift gears to profitability dimension. Apple has averaged a gross margin of 40.4% over the past decade, with the current margin standing at an even higher 44.1%. The operating margin is presently at 29.8%, slightly higher than the 10-year average of 28.1%. In free cash flow margin, Apple maintained an average of 23.6% over the last 10 years, and the current value remains robust at 23.2%. Lastly, the return on invested capital averaged 38.7% over the last decade, with the current value reaching an outstanding 49.8%. Moving on to the solvency dimension. Apple's quick ratio has seen a 10-year average of 1.12, but the current value has dipped to 0.94. The debt-to-equity ratio, which averaged 1.30 over the last decade, has increased to a current value of 1.79. Net debt-to-EBITDA ratio shows a current value of 0.39, maintaining the same level of its 10-year average of 0.38. Lastly, the debt-to-free cash flow ratio indicates that Apple could pay off its debt with the cash flows it generates in 1.25 years. Impressive. This compares to the 10-year average of 1.53 years. Now the important fourth dimension, valuation. The enterprise value to sales reveals a 10-year average of 4.65x, while the current multiple stands higher at 7.73x, implying a potential overvaluation. The enterprise value to EBITDA multiple averaged 14.53x over the last 10 years, but the current multiple has surged to 23.56x, indicating a potential overvaluation. Examining the price to free cash flow, the current multiple of 32.84x exceeds the 10-year average of 19.28x, signaling an overvaluation of Apple's stock. Lastly, the current value and the 10-year average of the price-to-earnings ratio are 30.05x and 19.10x, respectively. This further implies that Apple is currently overvalued. The fifth and last dimension is the shareholders' return. Apple grew its dividends at an annual average growth rate of 7.6% over the last decade, resulting in an extraordinary total increase of 108.9% on its dividends. However, despite these remarkable dividend increases, the dividend yield averaged 1.3% over the last 10 years but has currently dropped to a low level of 0.5%. The key metric of shares outstanding indicates that Apple has actively engaged in share buybacks over this 10-year period, leading to a remarkable decrease of 35.4% in the number of outstanding shares. I'll repeat, over the last decade, Apple bought back more than one-third of its outstanding shares. This is insane. To complete the 5D analysis, the payout ratio is currently at 16.9%. Apple's dividend is more than safe. Here are the ratings for the first dimension metrics and their average. The second dimension, profitability. The solvency dimension is rated as follows. The fourth dimension, valuation. And finally, these are the ratings for the fifth and last dimension. In this table, we have a summary of this section. The 5 dimensions final rating is 3.2. Now let's move on to Apple's DCF valuation. I employ Wall Street analysts' free cash flow projections to compute Apple's fair value. The average estimates of the next 5 years are utilized for a base case scenario, the highest estimates for a bull case scenario, and the lowest estimates for a bear case scenario. The base case prices Apple's stock fair value at $196.34, 6.5% above the current stock price, which indicates that the stock is undervalued. The bull case prices Apple's stock fair value at $266.63, 44.7% above the current stock price, which indicates that the stock is undervalued. Finally, the bear case prices Apple's stock fair value at $137.37, 25.5% below the current stock price, which indicates that the stock is overvalued. In summary, Apple earns a solid 5D rating of 3.2, and its weighted average price target is $198.60, implies a 7.8% undervaluation. Putting all together, my final verdict is, next round, Analysis 2.0. Apple appears to be fairly valued in the market. Furthermore, my assessment through the 5 dimensions indicates that Apple is indeed a strong business across all dimensions. To solidify my initial positive impression, I aim to conduct a comprehensive Analysis 2.0. Don't forget to subscribe to my channel and stay tuned for the next analyses.